Good afternoon. This is Jeff Camarda from the boardroom with another New York Minute. I'd like to talk a bit today about investment guarantees, particularly guaranteed things like government bonds and corporate bonds and so forth, which a lot of investors still hold, and a lot of you that hold them, I know, take great comfort in the fact that they are guaranteed, and even if the stock market goes up or down, or even if interest rates go up or down, that you're guaranteed to get your principal back at the end. And while that's true certainly for things that are thought to be riskless, like U.S. government bonds, despite the recent downgrade by Standard & Poor's, are still thought to be relatively riskless. That's only true for the bonds of that sort of underlying the revenue-producing capability and quality, which is another way of saying the U.S. government can tax as much as it needs to and is perceived to be able to make those bonds forever. Hopefully that's true. But that's not the case for other sorts of bonds, almost all other sorts of bonds, like corporate bonds that you might buy, or municipal bonds from the tax-free municipal bonds from a municipality or a local government, church bonds and that sort of thing. So it's important to remember that the guarantee on a bond is only so good as the issuer or the guarantor's willingness and ability to pay you back, because bonds go bad all the time. They go into default. They become junk bonds, and then some of those just become, the wallpaper. And it's very important, if you're a bond investor, to be aware of the changing credit quality of the underlying bond. And this is often expressed in the bond rating, but certainly 2008 showed us that bond ratings are not perfect, where many AAA, highest investment grade rated bonds, mortgage-backed securities and so forth, just became worthless virtually overnight. So investment guarantees, certainly you've got to take into consideration the quality of the guarantor and take that with a grain of salt. But there's another very insidious risk to investing, even in U.S. government issued riskless bonds, and that is the twin perils really of taxation and inflation. Now remember that you are paid back a bond not in today's dollars but in future dollars. And if inflation becomes an issue, as many of us in the financial community expect it will, with fiscal and monetary stimulus and the number of dollars that have been printed by the Federal Reserve in unprecedented quantities over the past couple of years, if the dollar ultimately becomes less and less valuable because there are more of them, then you're going to be paid back in less and less and less valuable dollars when you get your interest payments or you get your bond principal back at the end. So if inflation goes up, but your interest rate stays low, as it must, in virtually every sort of bond, the coupon rate is fixed at issue, you're going to get paid back with things that are a lot less valuable. And while a hamburger may cost $20 in inflated dollars, you're only getting $2 back, so to speak, based on your bond payment. So that's something to keep in mind. And another thing to be aware of is the dramatic impact of taxation and inflation. And these are the two things that you really need to take into consideration when figuring what your real return is. So last time I looked, inflation in the Wall Street Journal was running in the 3s, maybe 4%. And if you're getting 1.5%, 2% on that super high quality U.S. government bond and paying a piece of that in taxes, so maybe you're netting 1.4%, let's say, and inflation is running north of 3%, you're actually losing money. The bond is eroding in value, even though the dollar amount appears to be higher. It really is worth less in real world terms. And a lot of folks will say, well, gee whiz, if that happens and interest rates go up, I'll just sell my bond and buy another one. But let me ask you, if you have a bond now at 5% and interest rates go to 10%, obviously you'd rather have the 10% bond, but so would everybody else. So if you go to sell your bond paying 5%, or is the market going to buy yours at 5 or new one at 10? Obviously they'll buy the new one at 10. So what happens? Yours will sink in value until the actual return is equal to 10% on a new bond. That's how the bond market takes interest rate changes into consideration. So danger is on all three fronts. If you're a fixed income investor these days, be very careful. Don't have maturities go out too far. Look at the credit worthiness of the issuer. There are a lot more things to consider than you may have, but I hope that I've sparked your imagination and perhaps given you some ammunition to better protect yourself. I'm Jeff Camarda with today's New York Minute from the Boardroom. Bye-bye until next time.